Welcome to another edition of the Inspired Stories podcast, where leaders share their experiences so we can learn from their successes and be inspired by how they've overcome adversity. My name is Anthony Codispoti, and today's guest is Seth Levine. He is a partner at Foundry, a Boulder-based venture capital firm that invests in early-stage technology and supports founders through a strong network-driven approach. Foundry is known for its give first philosophy and helps entrepreneurs build lasting businesses in a supportive community. Over the years, he has advised venture funds worldwide and guided many entrepreneurs through growth and change. Seth also co-founded Good Bread, a platform that aims to expand financial access for small businesses. He co-founded Pledge 1%, a global network of companies that have pledged to give back to their local communities. And Seth has co-authored 2 books, The New Builders, which discusses the empowerment of women and people of color in the world of business, and his latest book, Capital Evolution, which explores how businesses, governments, and individuals can work together to create an economy that works for everyone. Now, before we get into all that good stuff, today's episode is brought to you by my company, Add Back Benefits Agency, where we offer very specific and unique employee benefits that are both great for your team and fiscally optimized for your bottom line. Imagine being able to give your employees free access to doctors, therapists, and prescription medications. And here's the fun part. The program actually puts more money into your employees' pockets and the company's too. One recent client was able to increase net profits by $900 per employee per year. Results vary for each company, and some organizations may not be eligible. To find out if your company qualifies, contact us today at addbackbenefits.com. All right, back to our guest today, Seth Levine. Thanks for making the time to share your story today.
Anthony, it's a pleasure to be here. Thank you for having me.
So, Seth, where did you first get your start in the entrepreneurial world? Did you have a lemonade stand? Were you selling comic books?
I had a SaaS business actually back in the day. It was a shoveling. The first S was shoveling as a service. I grew up outside of Boston, and to make a little money, snows in Boston, to make a little money, I used to go around the neighborhood. I was in Newton, so we moved there when I was in 4th grade. So probably call it 5th, 6th, 7th, 8th grade, somewhere in there was kind of when I was working on this. I would, offer to shovel people's walks for $5 or whatever, a driveway for $10 kind of thing. This is back in the 80s, and I had a lot of sort of older clients, elderly clients, and it occurred to me that it was kind of a pain to walk around house to house and ask if they wanted it on any given snow day. And so I came up with this idea that at the beginning of the winter, I would walk around and I would offer for $20 a month to shovel their walks or driveways as many times as it snowed.
Unlimited.
Unlimited, exactly. And so so a subscription business, shoveling as a service. And I got a decent number of clients, enough that I actually had a couple friends that I would pay. Of course, I was paying them on an hourly basis, right? Not or a per walk basis, not on a monthly basis. And most winters I did pretty well, right? I mean, there was obviously, it's just my time. So, winters where it snowed or months where it snowed 3 or 4 times, I was sort of begrudgingly walking out the 4th time and shoveling. But anyway, that's kind of how I got my start in entrepreneurship.
So was sales just like natural, easy to you?
Yeah, I mean, I like people. I'm a natural extrovert, so I really by the way, I also felt like it was something that was kind of offering them a bit of peace of mind, right? I mean, one of the things, and I think maybe the idea came because sometimes I would end up at someone's house later in the day just because, I'd start walking neighbor to neighbor, right? And by the time I got to someone's house, maybe a bunch of people said yes, and I was shoveling for hours. And people would say to me, "Hey, I wasn't sure if you were going to come today." Because it would be later in the afternoon. And that's where the idea came to me, was like, well, actually, why don't I give them an assurance that I will do it? And by doing that, I would do those houses first. That was part of my pitch, was like, look, I'm going to do the houses that sign up like this. I'm going to do first thing in the morning, and then I'll keep going around the rest of the day and try to make more money. And obviously, you're less likely to get clients later in the day because people have already figured it out, and either some other kid has showed up there, or more likely they've just shoveled it themselves. So anyway, that was kind of how it all
And what
came
you're
together, but it was
describing,
very
Seth, is
natural.
pretty clever, especially for like somebody in elementary school, junior high.
Yeah,
Did you get some
not bad
coaching
for
on
like
this?
fifth or sixth grader. It's funny. I was talking to someone about this the other day. I hadn't totally put this together, but in particular, my dad's father was incredibly entrepreneurial. He grew up in Denver, which is, I live in Colorado. He was one of 11 children. He dropped out of school. I think it might have even been middle school during the Great Depression, and he never went back. So he never even graduated from high school. And he ended up having this like very kind of middle class life. He was a salesman, and he sold cars. He sold check cashing, check writing machines. He for a while had a men's clothing store that he started. It was unfortunately wasn't successful, but and he kind of scraped together this really sort of very good, very nice middle class life. And my family is sort of the epitome of the American dream, right? So my grandfather didn't graduate from high school, let alone college. My grandmother, by the way, actually back in the 30s did graduate from college when it was much more unusual for women to go to college. She went to Colorado Women's College. And my dad has a PhD from Harvard, right? So like in one generation, my dad goes to Cal and then Harvard. And his dad, hadn't graduated from high school. And of course, his mom was sort of an early.
I love that. That really is the classic American dream. My dad came over to the country when he was just 8 years old. His parents didn't have anything better than a grade school education. He graduated from college, graduated from dental schools, gone on to start, many successful businesses, kind of on the shoulders of giants. Like if the earlier generation, say it again, Seth.
We both come at it naturally, right?
Yeah. Yeah. And, without the earlier generation sort of having, made the sacrifices and the strides for us, the path was paved.
Yeah.
I've got a lot of gratitude as I hear your story and I think about, similar connection to mine. And I think that you have as well, the way that you're talking about it.
Absolutely. And my grandfather and I were very close. And in sort of all growing up, I spent all my summers in Colorado. It's why I decided to move here. And but after I moved here, my grandfather and I, there was this wonderful Jewish deli down in Denver called Zadie's. And he and I would have breakfast together at least 2 days, sometimes 3 days a week. We would just meet there. He lived nearby, and this is, I was younger, I didn't have kids, stuff like that. But and that was like one of the great gifts of my life was the decision to move to Colorado and being able to spend that much time with my grandfather.
That's really cool.
Yeah.
Okay, so let's fast forward a whole bunch. How did you meet your partners at Foundry? Because this has turned into something pretty incredible.
Yeah, so it's a two-step story, Anthony. The first is I met Brad. I was working for a datacomms company sort of through the internet bubble, and the bubble burst, and I eventually they decided to focus on a portion of their business, and they had me run the rest of the business and sell it. It was a couple different business lines. Which is an incredible experience. I was in my 20s. I was running a $55 million P&L, had a couple hundred people working in my organization. I sold them off, but I could see that the sales were happening. That company had asked me to stay, but I knew I didn't want to stay. And so I had a summer where I had sold 2/3 of the businesses that I was supposed to sell, and I had one sale pending. I didn't have a lot to do, frankly. This is the summer of 2001. So the bubble's already burst, and I was taking long lunches, and I had a lot of friends who were about to get let go from Cisco and a couple of other places we'd meet and play basketball, stuff like that. Just waiting for this deal to get done. And I had to stay through the deal because I had some deal bonuses that were tied to that. But I kind of looked around and I was like, all right, I know I don't want to stay. What do I want to do? And I thought, I had a couple of offers to do corporate development or be like a GM of something. And I was like, I have a lot of friends that have tried. Early in my career, I was an investment banker, and I had some friends from banking who had gone into either venture or private equity. I don't know that I even totally understood the difference at the time. And I was like, that sounds kind of fun. I was youngish, and I was single at the time, and I didn't have kids. So I was like, yeah, now might be the time to do that. So I just networked into a bunch of people. Eventually someone introduced me to Brad. Brad was like crazy busy back then. It truly, like, we got this introduction, and he said, I'd love to sit down with you. and I got an appointment on his calendar 3 months later. Right. So, and so eventually I trek up. There's sort of a fun side story about like, what do you wear when you're going to meet Brad Feld for something that feels like a job interview? I was like,
was Brad Feld a person of recognition at that point?
yeah, everyone in Colorado, it turns out there aren't that many VCs in Colorado. And I naively thought, well, I'll just meet them all and someone will offer me a job, which was a crazy thing now that I understand how it actually works. But yeah, no, he was very well known, but also known for being a little eccentric, right? So I'm like, he will probably not even have socks or shoes on, but it's kind of an interview. Like I just wasn't wired to show up in jeans and a hoodie. And so I remember that they had this like crazy throne they had this like incubator thing that was sort of between Denver and Boulder. And they had this big throne with all these ornate decorations on it. So he sits me in the throne and he's like, so why are you up here? And we had this kind of amusing conversation. But anyway, it turns out they were hiring for an associate. And I ended up going through that process. Interesting story about Brad. We get to the end of the process. I'm one of 2 finalists. Brad wants to hire the other guy. And the rest of the team said, no, we think Seth's the right guy. And Brad, because he's Brad, said, okay, if it was like 4 or 5 other people, you guys all think Seth is the right guy, we'll hire Seth. And that's how close I came to not having the life that I have, right? Because everything changed for me when I met Brad and started working for Brad and then eventually with Brad. And so that was how I got my start at what was SoftBank Venture Capital and eventually became Mobius Venture Capital.
Got it. And so at what point did you go from working for Brad to working with Brad?
Yeah, so I joined SoftBank on September 7th, 2001. So it went straight into September 11th, right? Yeah. 4 days later, which just meant we couldn't travel. We already knew that the sort of venture bubble had burst, but it was worse than I sort of even thought it was going to be. And I joined to be an associate for 2 years. That turned into 3 years. Then they promoted me to this like super junior partner thing. And that's importantly where I met Ryan McIntyre, Jason Mendelsohn, who became sort of the other half of the Foundry partnership. And in 2005, then it was then called, they had then renamed it to Mobius. They tried to go raise another fund. And I actually sat down with Brad at some point, it's probably later in that year, and said, hey, Brad, I'm not quitting today, but I'm not going to stay at Mobius. At that point, I was married. We'd had our first kid. I was a super junior partner. Like to call me a partner was not even really a fair description of it. And I was going to get to do like 1 or 2 deals maybe in that first fund. And I was like, this just isn't working for me. And Brad said, hey, I don't actually think we're going to be able to raise this fund. Been thinking about maybe doing something, on my own. I would love to do it with you. And that we started talking about it. I don't know if he had already talked to Jason and Ryan about it. I'm not sure the exact sequence had sort of gotten blurred in the history, but ultimately said, hey, we're going to talk to Jason and Ryan about this. And they ended up moving out in kind of mid 2006. And we kind of figured out what eventually became Foundry, started raising the money in 2007. And then eventually closed the fund towards the end of that year. And it ended up being a great time to be an investor because we had a pile of capital through the GFC. And that was a really good time to start businesses.
So for somebody who's never heard of Foundry before, break it down for them. What is it?
Yeah, so Foundry is a pretty classic venture capital firm. We were a national investor, but based out of Boulder, Colorado. We've now, over the years, so we started in 2006, essentially, and we finished our first fundraise in 2007. So depending on how you count it, we're in close to 20 years in. We've raised about $4 billion. Yeah, it's a big pile of money. In 2016, we decided to expand our work. We had been investing personally in other venture funds, mostly funds from our friends, but a pretty interesting group of managers. And we thought that would be interesting to institutionalize. LPs are kind of a different animal than GPs. And we thought it would be interesting to try to be an LP that was a GP, right? So we had this experience running a fund, and we created this fund of funds. And that's really when our assets under management really ballooned. I mean,
explain that for me, Seth. An LP that is a GP.
So the people that are running the venture funds are very different than the people that allocate money to venture funds. So the limited partners, right, the fund of funds, the endowments, pensions, things like that, the people that operate those piles of capital and invest in venture just have a different. I tell people, I tell GPs this all the time. They have a very different job. They're asset allocators, and that is quite different in sort of training and mentality from someone who's actually in the venture business making direct investments into portfolio companies. And we recognized we needed a little bit of understanding of both of those worlds. Obviously, we were partners at a venture firm, so we knew how that world worked, but we ended up bringing in our largest limited partner, our largest investor in Foundry, a guy who built the University of Texas investment management companies. So that basically the Texas college and university systems retirement plan, their private markets and specifically emerging managers market portfolio, a guy named Lyndall Ekman. So we brought him into Foundry and in 2016 raised capital to basically be a fund. We didn't call it a fund of funds, but essentially that's what we were doing. So to become a fund of funds. So now Foundry invests in other venture funds. We've got about 50, give or take, venture funds that we've invested in, as well as directly into companies. And they kind of feed each other, right? We learn about new managers through our work as an investor. We can evaluate them better in our minds as an investor. And we often co-invest with them. We typically invest in funds that invest earlier than we do. So we get a chance to see a few thousand companies and we pick the ones that we think are most interesting to partner on.
And what is it you're looking for? Is it all tech related? What are the check boxes that either the fund or the company directly has to satisfy for you?
Yeah, it's all tech related. These days, that's a pretty broad category. I would say we invest in what we call themes. We write about it on the website. I won't go through all of them here, but areas that have been very successful for us in particular are marketplace businesses. We've invested in a number of very well-known marketplaces, SeatGeek, Rover, the dog sitting platform, a bunch of others. So that's been a popular area for us. We like what we call glue, which is technologies that other technologists would buy, so intermediary technologies. And then we also have had a lot of success in, I'll call them hardware companies. We really think of them as bits surrounded by atoms. So usually there's a heavy software component. Examples of that would be Fitbit, that I think everyone has heard of at this point, but also something like Whoop, let's say, or even MakerBot, which is one of the early 3D printing companies. So those are areas, that's not exclusively, I mean, I didn't describe everything we do, but those are some areas that we tend to lean in on.
And when is it in the life cycle of the company that you're traditionally coming in?
Typically, it's Series A for us. So, and the definition of that has changed over time. So, it used to be maybe a little bit earlier. Now it's sort of post-product market fit. Typically, a company has, let's say, at least $3 to $5 million worth of revenue. So, there's some customers, there are numbers to crunch and to do some due diligence. Occasionally, we'll write an earlier check, and occasionally we'll write a later check. Right? With sometimes we've done a few deals where we've written, $15, $20 million checks into companies that are a bit later stage, but for us still have venture risk. So when I say later stage, I don't mean pre-IPO round where they're a 10 or $20 billion valuation. I mean maybe a few $100 million valuation up to call it $500 million valuation. They've call it Series C, Series D. Again, the numbers kind of or the letters shift around a bit, but try to give people a flavor.
So where you guys come in the life cycle, then what are you traditionally seeing as like a success rate? Right? The earlier that you get involved, the more failures that you're going to have. The later you get involved, the more successes that you're going to have. You guys are still getting in pretty early.
And I'd say the success rate has moved up because we've gone a little later. So if I look at the first fund, about 2/3 of that capital went to effectively zero. And that was a 6X fund, right? It was a very successful fund. It was just highly, highly concentrated. Now, we did more seed and Series A in that fund. And again, what Series A meant was earlier back. This is 2007 to 2010, essentially. And then as you go forward in fund life, our success rate has gotten higher because we've mixed in assets that we invested in a little bit later, but it's still probably 50-50. And it depends a little bit on what you define as success, right? I mean, if success, we've done a much better job of getting our capital back or making a couple times our capital on things that weren't really working. And we try to continue to expose ourselves to these outlier companies that, in the case of Fitbit, was multi-hundreds of X return on an investment. We've got a handful of those that still exist in the later funds as well.
When we had Brad Feld on the show some months ago, we talked quite a bit about the give first philosophy that he believes strongly in. You guys at Foundry believe strongly in. Can you share a story, an example of when this give first approach maybe really had an impact on a founder or a fund relationship in a way that you didn't expect?
Let me make it really personal because it's had an incredible and a profound impact on me and my life. It's interesting, Anthony. I was, of course, I read Brad's book. I read an early copy and gave him some feedback. And he mentioned something, and then the book came out, and he's been doing, podcasts and things like that. As you mentioned, he was on your show, and he mentioned a book that I hadn't read. It's Give and Take by Adam Grant. And I was reading, so I read it. I don't know why I missed it. I've read most of Adam's works. And about halfway through, I sent Brad a message and I said, this book is about you. And it's really made me realize just this incredible gift that you've given me, this philosophy of give first. And I asked him the question, I posed the question. I think I was maybe predisposed to this idea, but I don't know that if I had not met you and we didn't have the relationship we had, that I really would have internalized it the way that I did. But I also acknowledged, and this is in the actual answer to your question, that Brad was this way with me, right? I learned the venture business because of Brad's willingness to give to me. And when we started Foundry, very specifically, Brad was in a position, he was by far the most well-known of the four of us. He had a real track record. He'd been a partner at a venture firm for more than a decade at that point. And he could have easily said, we're calling it Feld Ventures and I'm taking half the economics. And he very clearly said to us and the world, that's not the kind of firm that I want to be a part of. I want us to be equal. And we set up a fund in which we were equal. We owned Foundry equally. We had slightly different carry in that first fund, but nowhere close to what Brad could have commanded. And that was incredibly impactful on me. It was incredibly impactful from a financial perspective, for sure, but it was also impactful for me from a philosophical and an approach perspective. I think that, knowing Brad has changed my life, right? I think that's true of a lot of people. It's amazing how many people I bump into who say, oh my God, Brad gave me 3 minutes 10 years ago and it totally changed what I was thinking about and completely altered the trajectory of my life. And I've consistently tried to, I'll never actually live up to that because Brad is at a different plane than I am, but I constantly try to emulate that. How do I provide value to people? He's been so selfless about doing that. So it's affected me very directly. It's affected me because it modeled behavior that I want to emulate and continue to strive to emulate. And I'm just really, Brad's one of my closest friends, so it's funny to talk about him this way, but, and we've had this 20 plus year partnership. He and I started working together as I said, in 2001. So we're 25 years into our working relationship, and it's had a profound impact on my life.
So when people hear give first philosophy, I think they can mostly connect the dots on what that means, but let me see if I can encapsulate it in a way that accurately reflects the intention of it. It is, as it sounds, give first in a relationship. How can I help you, Seth, right? How can I help you, Brad? And there isn't the immediate expectation for some kind of quid pro quo. I'm not expecting Seth or Brad to turn around and, give me a share in their company or whatever it is. There is an expectation that at some point, somewhere in the universe, that karma is going to come back to me, right? And my ability to give, I might not get something back directly from Seth today, but maybe Seth makes an introduction to somebody that, then is able to help me in a different way. Am I thinking about this correctly?
Yes. And that last piece is so important, Anthony. I'm glad that you have sort of grabbed that and have acknowledged it here, because I think that's a piece to give first that I think some people tend to skip over or not understand. And because of that, I think that there can be a tendency for people to feel like, oh, give first is this extractive thing, right? You give, and you're taking, right, from an individual in favor of a community. And there are people who sort of get sucked into that and feel like I'm never going to get anything back, or there's this expectation that I never get anything back. And that's not what give first means. And I think that last piece, as you accurately described it, is really important. It's not that I don't expect stuff to come back. It's just that I don't expect it to be a one-to-one relationship. And I don't know the form in which it's going to come back. But I think it's particularly important to say that, because I think there are, in particular, very specific communities of people who historically give a lot and don't get anything back, and where it's expected that they just simply give of themselves, right? I think we've in our society in particular have treated women with this lens. And I've had a couple women specifically say to me, hey, I feel like this could be exploitative of me and my time. And it's really important to say, no. If you feel like that's happening, then you're sort of giving too much, and you're not sort of requesting something back from the community. So I think it's a really important point. I was not sensitive to this until a friend of mine, she called me out on it and said, hey, this is what it sounds like to me. And that's when I started personally using different language. I don't know, Brad, I've noticed Brad using this language as well. I know he used it when he talked to you. And so I assume someone has talked to him a little bit about that as well. And it's kind of changed the way I think he's always thought about it this way. And we've always thought about give first this way. But I think this has changed how he's talked about it.
So how does someone guard against giving too much and not receiving anything in return?
Yeah,
is that even the right question to ask?
I think so. I think it's fair to say. I don't advise people to keep a ledger and say, okay, well, I've given 10 ducats and I've gotten 6 ducats back. And by the way, different people, I am totally fine having an imbalance, right? I'm not expecting to get the same things back from community, and I don't really know how and in what form things come back to me, right? And I think for me, a lot of stuff sort of happens in the background, and I don't know. I'm in the middle of a book launch. I'm seeing a lot of give back now, right? I've had a ton of people. The book actually launched yesterday. It was available yesterday, and I had a ton of people posting on social and telling people about it and buying books and showing up to the launch event, things like that. And for me, that was getting back from community, and I felt that very warmly. But the way that I think you guard against it is that and each person needs to decide this individually, but you need to be thoughtful about how and when and what time you're giving. And I'll tell a story later about sort of just a breakdown in my life around just too much to do. And part of that breakdown was I was not putting appropriate boundaries, in that case, on my schedule. Anyone who wanted to get on my schedule was getting on. And I felt like that was part of Give First. And I realized that there were other ways for me to provide back information in an email, writing about certain topics and pointing people to my blog more, writing the books that I've been writing, for example, things like that, that were a way for me to avoid these one-on-one meetings. And I needed to realize it was okay to say to people, hey, I don't have time to meet with you face to face, right? But I'm happy to answer some questions over email, or here's what I think might be helpful to you. And it took me a little bit to understand that. So that's just one example from me personally, where I needed to put some limits on what I was giving because it just got to be too much.
You made a comment before, Seth, about certain communities of people, I don't know, being at greater risk for having, give and not receive back. And you specifically pointed out women. I wonder if this ties into any of the motivation for co-authoring your first book, The New Builders. Can you talk about that?
Yeah, thanks for asking about that. I really, I love the venture books that are about people's experiences and company stories and things like that. And this, what I'm going to say is not to take away from those, but the 2 books that I've written are pretty different, right? There was a lot of research that went into them. It's not really sort of stories of my life as a venture capitalist. Instead, they are stories about topics that I, care deeply about. Originally, I decided to write what became The New Builders because my co-author and I, she's a business journalist. I'd known her for a few years before this. We loved trading stories about entrepreneurs doing interesting things kind of out of the Main Street lens. It started with some international entrepreneurs because we met over entrepreneurs that were working in Palestine and in the West Bank specifically. And so we were trading these stories, and we thought, well, wouldn't it be fun to write a book, kind of a lighthearted book, actually, about people that, maybe are overlooked by mainstream media, and we didn't know the stories of them. And so that's how it started. As we researched it, we realized actually two things. One is that the people starting businesses today were much more likely to be women and people of color and immigrants, as they always have been, and that we were not doing a good job of connecting capital to these businesses. Capital writ large, right? Not just venture. Venture is like 1% of companies, so it's important, but it's not. It's a tiny number of businesses relative to what we're talking about. And that became a much more urgent in our mind story to tell. And so we decided it was going to be a more serious book than we had originally thought. And we started writing it up or researching it. And then as we started writing, COVID hit. And of course, businesses that were owned by, in particular, women and people of color were disproportionately affected by COVID, in large part because they had lower cash reserves. So we really felt an urgency to get it out. And so the book is sort of a combination of research studies and statistics, but really punctuated by vignettes. We tell the stories of a bunch of entrepreneurs. Each chapter is about a trend, and we tell the story of an entrepreneur that exemplifies that trend, and then we talk about the broader trend. And it really became a sort of a passion project, right? Something that we felt so strongly about. I'm proud of both books. I'm very proud of the way that book came out, and frankly, the impact that it had. In particular, it got passed around on Capitol Hill quite a bit. And
is that right?
Yeah. And we know specifically, because we heard from some staffers, that it actually shaped some of the pandemic relief monies and bills, because it forced them to think differently about the types of businesses that were actually impacted by COVID.
Can you say more specifically about how it influenced it?
I think specifically there were some of the initial COVID relief funds kind of skipped over small businesses, right? And they were really targeted towards kind of venture-backed companies. And again, look, we at Foundry, our companies took advantage of those things. It saved a bunch of businesses. I have no problem with what the government did to try to bolster the innovation economy, but they were doing it by at the expense of or by ignoring businesses that were more Main Street businesses. And sort of the second COVID Relief Act tried to fix that by channeling more money very directly to smaller businesses.
That's fascinating.
Yeah.
Any idea how it first got seated there in Capitol Hill?
I know that it was a staffer from Tim Kaine's office. I don't know how they found it, Anthony. It's really interesting. And I mean, look, my hope for the new book is that something similar happens. It's the new book's it's about a broader topic, so I think it has sort of more broad applicability. But we're doing an event in DC in a month or so, and I know that some staffers have already been kind of passing it around. So I hope that it has the same effect.
That's cool. Let's talk about the new book. Perfect segue.
Great.
Capital Evolution. What was the inspiration to co-authoring this one?
Well, I had I'm interested to describe this story because I think it'll resonate with your listeners. The impetus for this book came from a dinner that I had with a portfolio company of mine in New York. It was a board meeting style dinner. There were a bunch of the management team, the CEO. I was the only out of town investor, so it got a little late and all the other investors left. It was just me, the CEO, and the rest of the management team. We started talking about sort of the role of a company in society these days. And it was shortly after Dobbs, the abortion decision came down from the Supreme Court. And one of our other CEOs had written something on LinkedIn about it and had gotten feedback both from people who felt like he didn't go far enough and people who felt like he went too far, both of whom worked for him, right? Not both people, both classes of people who worked for him. He had a pretty big company. And the CEO was asking me, basically, like, would you accept a lower return for us living our values? And we ended up having this whole discussion. Of course, I gave him a VC style answer, which was like, no, I don't think you have to make that choice, which actually I believe in. But we ended up talking about it quite a bit. And he was saying, hey, we run a business. We have a lot of Fortune 100 customers, and they may have different sets of values than we do. And I've started to think a little bit more about, well, what do I what am I supposed to talk about, right? My employees want me to come out and address the issues of the day. It was just past Pride Month, and they had changed their logo to the sort of multicolored flag version of their logo on their website without really thinking about it. And he was like, is that appropriate? Like, is that what companies should be doing? It was a really interesting question. And so, as I am wont to do, I called up Elizabeth, who's my co-author on the first book, and she and I have become very close friends. And when I have interesting questions like this, she's the first person I think about. So I called her and said, "This is super interesting." And as we typically do, we sort of batted it around and decided, well, let's ask some other people their opinion on this. So we started doing some research, not with the idea that we were going to write a book on it, but just because we wanted to understand how were people thinking about it. And that's when we realized there's an interesting story to be told here about the rise of business in society relative to government and media, and what are we asking businesses to do? And so that became what ended up being the sort of the basis for the book. The book is about a broader set of topics, which is really the future of capitalism. Turns out it's a bit of a defense of capitalism, which 3 years ago when we started researching it, maybe felt like it was less urgent to defend. But I think sitting here today probably is very urgent to defend and at least urgent to have a conversation about. But we also talk about the ways in which neoliberal capitalism, which is the capitalism we've been living under for the last 50 years or so, is maybe not working so well. And we outline an idea for how to change it.
What is that idea? Well, let's take a step back. Define the liberal capitalism that you say we've been living under for the last 50 years and why you think it's not working.
Yeah.
And we'll kind of move into what maybe the fix is.
Yeah, thank you. I think it's actually important to do that, Anthony. So Milton Friedman, who many people listening have likely heard of, he was an economist most closely associated with the University of Chicago. He came out with a bunch of ideas about how the economy should be organized. He wrote a big book about it in the late 60s, and then he wrote an article in the New York Times in 1970. It was a bit more digestible, so it became more popular. And in it, he described that the only responsibility of a business is to shareholders. That was, I'm paraphrasing slightly, but only slightly. That was the title of the article. And a bunch of people, it didn't get adopted right away, but over the sort of course of the 70s, and in particular in the 80s, specifically with Ronald Reagan and with Margaret Thatcher, so in the US and the UK, but then globally, these ideas really became embraced. And the idea was that the only thing that corporate managers and boards needed to worry about was making money for shareholders. And it did a couple things. One is it sort of demonized government. Reagan famously said, "Government's not the solution; it's the problem." And it forced sort of this very short-term thinking upon companies, right? Where managers were incented. Shortly after this, there was another paper by a couple of Harvard economists that really sort of became the basis upon which the stock-based compensation movement ended up, specifically for executives, ended up sort of taking off. And some may argue to sort of like a crazy extent. And really that's what we've been operating under for the last 50 years, right? 1970 through today, which is this idea that corporate managers only need to care about their shareholders. And we think that that's short-sighted and a bit naive. And the result of that has been our economy has grown slower than it had been, right? So if you look at the economy from post-World War II through 1970, and there's a bunch of reasons why it grew potentially faster, right? We had a bunch of people returning from the war. We had very generous education programs, the GI Bill specifically. Women were entering the workforce. That was a huge unlock for the GDP growth in the United States. But the economy was growing faster and it was growing much more equally. And then after the 1970s, the economy and our economic growth slowed and became much more unequal. And so during that time period, just as one statistic to make it real, the compensation for senior executives grew by about 900%. The compensation for workers grew 12% total. Wow. Right through that. So it's everyone knows the stats, right? I mean, the concentration of wealth is gotten pretty alarming. And you see it in our divided politics and in the rise of populism, right? Both on the left and the right. It's the reason why double-digit percentage of Mandami voters voted for Trump. They care about the same things, right? In terms of inequalities, they say they care about the same things. Their prescriptions are very, very different, but everyone, I think when Mandami went to the White House, everyone expected fireworks, and it turns out they just agreed on a lot of stuff because, the typical Trump sort of MAGA base, if you will, had the same underlying challenges, opportunity, lack of opportunity specifically, that the Mamdani voters have.
Which is what?
Which is the dynamism in the United States economy has largely gone away. We think about the American dream, the idea of being able to lift yourself up through your own sort of ingenuity and hard work, and the ability to essentially out-earn your parents. And both of those things have largely gone away. I mean, just as one example, just to make it really clear, 50 years ago, if you were born in the bottom 25th percentile of wealth, you had a 25% chance of dying in the top 25th percentile of wealth. Today, and that is the American dream, right? It's the ability to make yourself, and improve your station in life. Today, you have a 5% chance of rising from the bottom 25th percentile to the top 25th percentile. So this opportunity economy has largely gone away. And a lot of what we argue for in the book is for ways that we can return to that. And we felt like this book was necessary because a book like this actually hadn't really been written. There are plenty of people that have written something about evolving capitalism or changing capitalism, and they've tended to fall into two camps. One is academics who write these sort of largely unrealistic policy treatises that are relatively dense and not super readable, and sort of they lack a lot of business experience, and so it's sort of written from that perspective. Or let's say the CEO who writes about their own personal journey and they've had this incredibly successful business and they did it this way, and shouldn't more people do it this way? And both of those books are interesting and we read a lot of them, but we wanted to write a book for the masses that was written from the perspective of people that have actually been in business for decades and draws from conversations that we had with really, almost 100 people some of whom were academics, many of whom were CEOs, some of whom are CEOs that you've heard of, right? Jamie Dimon from JP Morgan Chase sat down with us. Dan Schulman, who's now the CEO of Verizon, was the CEO of PayPal, a bunch of people like that. But also companies that maybe you've never heard of, and workers sort of across the spectrum of seniority, to just try to get a lot of perspectives and then distill it into what I hope is a very readable and accessible work.
So help me wrap my head around exactly what the problem of the last 50 years have been. Liberal capitalism, did it work for the period of time that it was working, or was it always flawed back then? And now we're just finally starting to see the cracks.
I think it was. So I think my answer is nuanced, and we try to treat it in a nuanced sense. We actually have a chapter called "The Beauty and Fallacy of Milton Friedman." I really tried. I wrote the first draft of that chapter personally, and I really tried to get behind the time in which Milton Friedman grew up, right? Came of age post World War II, was one of the guys who actually, met at, Mount Britain and tried to come up with the new economy, right? For the entire world that was amongst this sort of group of very now famous economists, Schumpeter and Hayek and others who were there. And so I tried to understand that in context. I think it worked better earlier on because we've now had this like Frankenstein version of Friedmanism and neoliberal capitalism. And it started out maybe a little less harsh. Even Friedman talked about investing in employees and things like that. But what happened over time is that we treated everything below the revenue line as something that needed to be extracted from and essentially minimized, right? It needed to be optimized. And the result was very short-term thinking and very extractive thinking, both around, in particular, labor, but also around the environment. And our view is those things aren't sustainable. And you only need to look at, you can look at the environment and sort of what's happened there to see that extracting from the environment is not going to be able to be continued. And I think we've kind of gotten our heads around that mostly. But also sort of look at our current politics to see that we've extracted too much from labor. And by the way, or middle class, let's say, and at the same time, our economy really grows on the backs of the middle class, right? The truth is that the consumer economy is roughly 2/3 of the U.S. economy. And the way that we've done that is we sort of traded off not increasing wages for the promise of cheap stuff, right? You can buy a $200 television and that should make everyone happy. And we combined it with zero or close to zero interest debt for so many years. And really, we're sort of at the limit of the middle class's ability to take on more debt and therefore continue to consume. And so part of the argument we make, Anthony, and this is really important, is that we believe that we can grow the overall pie faster by making some changes in the economy. We'll talk about it in a minute. But it's not it's not a redistributive argument, right? It's not a sort of a there should be no billionaires kind of argument. That I just think that falls short. I really prefer to think of the world as like strong floor, no ceiling. I'm borrowing from my friend Oliver Libby, who wrote a book with that title. But I do believe that there should be no cap on opportunity, but we should provide the ability for more people to participate in that opportunity economy.
Got you. So in the past, the problem has been just trying to squeeze everything that we can from lower and middle class people in terms of income, and not allowing them to sort of participate at the full level, not giving them as many opportunities to rise up from the lower quartile to the upper quartile. And so the plan in the book, some of the ideas that you outlined there are, how can we make this better? How can we make this more inclusive again?
Yes, exactly. And I let me describe one more thing, but I want to say that it's important for listeners to understand this is what we're proposing is not some radical redefinition of capitalism, right? It's a shift in capitalism, but it's a little bit of I don't want to call it a subtle shift because it's a real shift. But it recognizes in particular, and I'll describe sort of the four key pillars of what we call dynamic capitalism, which is what we believe we're sort of we think we've actually moved away from neoliberalism. That in 2019, the Business Roundtable, which is a group of about 200 of the biggest CEOs of the biggest companies in the United States, came out with their own statement of a purpose of a corporation. And in it, they very clearly described that there are other stakeholders other than shareholders, specifically employees, the community, environment, and suppliers. Jamie Dimon happened to be the CEO of the Business Roundtable at the time, and so we spent some time talking with him about this, and we got the story behind that. We tell it in the book. But so we've kind of moved into this what we describe as like a messy middle. So it's not clear. Maybe we'll pull back to neoliberalism. Maybe we'll move on to something else. Trump is this sort of weird figure that's like a kind of a person or a personality of the neoliberal age, but he talks a lot more like a dynamic capitalist, and he sort of governs sometimes as a dynamic capitalist, sometimes not, more as a neoliberal. It's sort of a interesting figure, which I think is more just evidence that we're in this transition, and we haven't quite figured out what comes next. But really, there's historically in the United States been this division that we have created between capital and labor. And the division was maybe slightly less important when the percentage of top line for most businesses that ended up going to labor was significantly higher. But what's happened over the last 50 years, we actually have a chart on this in the book, is that percentage of revenue that goes to labor has gotten smaller and smaller. We have minimized that because neoliberalism says you need to extract from that. Now, there's no argument in the book that companies should somehow be less efficient. So that's not at all what we're saying. But we are saying that we need more pathways to ownership, and maybe to state it in a way that I hope people will sort of appreciate and maybe want to adopt is, how do we create more capitalists, right? If you believe in a capitalist economy, then we should want more capitalists. And I think if you look at what people said about why they voted for a socialist in the financial capital of the world, in New York, the reason that they said that was because they felt like they didn't have any purchase on the economic ladder of the United States. They were so swimming in debt of some kind. They felt like there was no opportunity to create wealth. They could not afford a house. The average age of a first-time home buyer has increased to 41 now, up from like the late 20s 15 years ago, right? So people don't feel like they've got a stake in the market economy. How do we give more? I mean, the solution is, how do we give more people a stake in the market economy?
So what's the solution? What are the four pillars?
Yeah. So thank you. I can easily go off forever. I should not forget to actually say what they are. So there's four things. And again, these are not radical things. One is a shift from short-term to longer-term thinking. And we've already seen this in some companies. I mean, when Google went public, they wrote a long sort of dear shareholder letter that described that they were going to think about the long term, not the short term. And by the way, companies under neoliberalism aren't particularly good at perpetuating themselves. The average half-life of a Fortune 500 company is 20 years. So it's not like neoliberalism and this focus on the short term was creating these sort of long-term benefits to companies and their executives. So Short-term thinking, no. Long-term thinking, yes. That's thing one. Thing two, I've already addressed, which is an empowerment of the ownership economy. We have a bunch of ideas for how to do that very specifically in the book. The third is a role for government, but a limited role for government. We have a law, we have an entire chapter that kind of goes through this, and this theme sort of weaves its way in and out of the book. But I think there's a propensity on one side, certainly in the neoliberal side, but also I think in general on the right side of the political spectrum, to say everything government does is terrible. Government should be involved in anything. And I think there's also a propensity on the far left side to say government's the solution to everything. Government should be way more involved in people's lives. And we wanted to very clearly outline that we feel like neither of those two ideas is correct. The right idea is probably closer to less government intervention in our economy, lower regulations, things like that. So we go through that in the book. But it's important to say. And then the last thing, which is a little bit, it's kind of funny that we have to talk about it right now, but it's true in this day and age, which is the respect of the rule of law, or respect for the rule of law. And market economies can't function, and the law, by the way, equally applied to everyone in our economy and our society. Markets can't function without guardrails and rules. And we are at a bit of a dangerous time in the United States where respect for the rule of law is maybe being challenged, right? And the law is not necessarily being applied equally across people. And so that's important to say. And so as we were talking about, sort of early on writing the book, the first three ideas came out very clearly. And then towards the end of our writing, we realized that fourth pillar is something that we really need to add.
Who is your book going to make angry?
Wow. I hope a lot of people, actually, right? I mean, I think it's going to make people angry, like sort of classic neoliberals, right? And there's a lot of people who still have a stake in that style of economy. And I think the book will frustrate them because they believe the system is working for them, and they don't believe, and this is important, that an economy that works for more people ultimately will also be better for them. And that's the argument we're trying to make. But I think there's a lot of people, and they're not just on the right side of the political spectrum, but I think in this sort of category, they're more likely to be. I think they won't like this at all. They don't like this idea. They think it's too messy. Shareholders only is simple. What you're talking about is too frou-frou. Impact same people that are sort of going after DEI and impact investing and things like that. And we have a very nuanced discussion about what those things are and what's the government role in those sorts of ideas. And maybe we've gone a little bit too far on many of them. And then I think also it'll anger plenty of people on the left side of the political spectrum who are like, look, capitalism is irredeemable. I don't even want to hear about it. We actually address this early on in the book. We have a chapter about whether capitalism can be saved. And I just think there's a lot of people, and I've talked to many of them, who just say, no, there's no role for capitalism. We need something else. And I guess their read of history, even though there is not an example of a socialist system, certainly at scale, that has been successful, but their read of history somehow is that, I don't know, everyone else has done it wrong and now we're going to do it right now or whatever. I mean, I don't mean to, I'm dismissive in the sense that I don't agree. I don't mean to sound so dismissive that I'm not willing to listen to them. But I think that it'll anger those people as well. And we have a very nuanced view, for example, around the energy economy, right? The energy economy, we won the 20th century. The United States won the 20th century. We had the largest economy, fastest growing, sort of by every metric. Most people, not in poverty, things like that. We won that economy because we won the energy economy. And whoever wins the 21st century will also have won the energy economy, right? We need more electrons in the world. And so we have a pretty nuanced view of that. And those people that are like, hey, we need to have a moratorium on fossil fuels in whatever, 2030, that just doesn't make any sense. And by the way, we don't believe we need to do that and be able to still have a planet we can live on. And so I think there's plenty of people who will read those sorts of things and either dismiss it or dismiss me. I'm a capitalist by job title, right? It's pretty easy to, sort of wave your hand and say, no, I think these ideas are dumb. And what I've been encouraging people, and I've gotten to a few of these discussions on Twitter recently, is like, read the book, right? Like, don't give me your feedback based on the 200 character version of what we wrote. Like, actually read it and then tell me what you agree and disagree with.
Short answer, Seth. What's the single biggest lever that we could pull to achieve the goals that you have in mind?
Create more owners.
Love it.
100%. We've done that, by the way. We've done a pretty good job of that in, call it, tech entrepreneurship. And I think a lot of people that are inside of tech entrepreneurship, because it's very common to have most employees have some form of stock option or something, don't realize how little that idea has actually pervaded the rest of the economy. And so we talk about, in particular, we talk about a couple of guys who are working on this. One especially at KKR, Pete Stavros, who is bringing some of these employee ownership ideas to much more sort of mainline manufacturing businesses in his case, but more broadly. And by the way, stock options are only one form of how you think about an ownership economy as we go through a couple of other ideas. But EOPs, which are employee ownership, there's like a couple dozen EOPs in the entire United States. There's 33 million businesses in the United States, and there's a couple of dozen EOPs, right? So as one example, but there's some other pathways to ownership that we describe. But if there's one thing that I think we could do, it is to create more owners. I want to get rid of this distinction between the capital class and the labor class, and I want to create far more capitalists than we have today.
Love that. Let's shift gears, Seth. I would love, because people look at you from the outside and are like, oh, wow, Seth, bright guy, very successful, things just come easy, right? Get to invest in all these really cool companies. What's a really hard thing that you've had to overcome in your life, whether it's something personal or professional? And what did you learn going through that?
I mean, one of the stories that I like to tell, because I think people do sort of look at me or Foundry and sort of say, like, that was easy, right? You were always going to be successful. And for starters, and no, it wasn't, right? Foundry has been hard on many levels at many times, and it's very imperfect. When we first started Foundry, so it's 2006, and the four of us came together and started sort of working on the things you needed to do, and capital raising back then was a little bit different. We had to create an offering memorandum. We hired lawyers, all the things to do that. And I'd made a little bit of money, but not a lot of money. And I put my entire savings into Foundry, right? It was six figures, but barely. We started fundraising in January of 2007. And by May, it was really clear it wasn't going to come together, right? There were no emerging managers back then. The conventional wisdom was you needed to be in one of probably 8 venture firms, or it wasn't worth being in that asset class. There were a couple of what we would now think about as emerging managers that had raised their funds, but they weren't well known yet, and they had not been successful. So Union Square existed, and these are all firms we were close to, but Union Square existed, First Round existed, True existed, and Spark existed, but no one knew who they were, and there was no thesis around it. And I actually very much remember coming home in May of that year, so this is 2020 or 2007, and saying to my wife, "This isn't going to work." And by the way, I lost our life savings, right? I mean, we weren't going to like lose our house, let's say, but I was going to have to go like find another job. We'd had a kid, and my wife was at the time staying. She's done a lot of different jobs. She's a real estate developer right now, owns a bookstore in our town, all sorts of things. But at the time, she was working part time and home with our kids, and I was like, it's not going to work. I'm going to have to go figure something out. And I like totally lost our life savings. Her response wasn't, holy crap, what are we going to do? Her response was, I believe in you guys. I think this is going to come together. Give it a bit more time. And ultimately that is what happened. Right. And the big thing for us was, my now partner, Linda Leckman at UTIMCO, said yes. And as many entrepreneurs who are listening know, like once you get a couple of yeses, all of a sudden it steamrolls. And we went from thinking that the fund wasn't going to come together in May to, by July, sort of realizing it was going to come together and it was going to likely be oversubscribed. We actually were trying to, at the time, raise $175 million. We ended up deciding to put a cap on it at $225. All of our early stage funds ended up being $225 million. And that was kind of the history there. And obviously, my wife and I have been together for 25 years now, but like that was a really important moment in our relationship, right? Because it wasn't just a like, hey, honey, I believe in you. It was like, hey, no, we have a real stake in what's going on right now. And I know that this is going to work out. And I think you just need to like give it a little bit more time. And so I think that's an important story because it really was both. Foundry was an all-in thing for me. And obviously ultimately worked out really well. But there was that moment in time when I was certain it was not working.
What was the inflection point? What allowed that to switch?
The one thing was Lyndall saying, I'm there. I'm going to do this. Right. And thank goodness that he had a thesis around emerging managers. He had invested in both True and USV. And I think eventually Spark as well. And so he was like, hey, I actually think that there will be this class of entrepreneurs. Interestingly, most of those funds were not in the Bay Area. True was, but USV, Spark, and Foundry were not. And he had a real thesis around that, and that was the catalyst. But ultimately, it was, and this is true for a lot of entrepreneurs. Like, you have to stick with it. And we really, it was a good reminder that, like, a lot of things that seem easy in sort of hindsight were not easy. And the truth is, raising Foundry's first fund was not easy, and we needed to persevere. And maybe there's some, parallel universes where it didn't come together, and Lyndall didn't say yes, right? And we weren't able to manage it. And I don't know what I would be doing in that universe, but it'd be very different than this one.
Interesting. So without Lyndall saying yes, that your future could have looked a lot different. There was somebody who believed in you that bought in.
Yeah.
And you raise a really interesting point, Seth, about entrepreneurs just need to keep going, right? Persevere. Because what we often hear, the overnight success, and I'm using air quotes for those people who are just listening, excuse me. So almost never is there an actual overnight success, right? It's something that you didn't hear anything about, that people were toiling away in the background for years to bring to fruition. And then, when it finally pops up out of the ground as this beautiful flower, that's when you get to pay attention to it and see it. But, there's so many people grinding, working on something really hard. How do you think about, because there's some times where things just don't work, right? Even in the venture space, you've seen a lot of companies that They put their best effort in and there wasn't a product market fit, whatever, something happens, it just doesn't work out. So how do you think about that? Like, sort of like, when do you know when you need to keep putting nose to grindstone versus, hey, it's just time to hang it up?
Yeah. And I'm sorry to give an answer that's messy, because oftentimes you don't really know, right? Or in hindsight. And I say that because so many times in my career, in the history of Foundry, we have put more money into something thinking it was just about to turn the corner, and it didn't, right? And oftentimes that's what it takes, is like, we're going to try one more time, and sometimes one more time after the one more time, before we finally get it in our thick skulls. This is not working, right? And look, one of the things that I think distinguishes the United States from other entrepreneurial economies is our acceptance of and even embrace of failure. And so I think that's positive, right? So when you get to the end of the line and say, look, it just didn't work, it didn't work. But it's very hard. And I think this is one of the reasons that we have an effective partnership, for example, is that the person who is closest, which is the CEO, the founding team, and oftentimes the board, the partner that is on the deal, they have the least perspective, right? And I think one of the things that an effective partnership does is they push each other, right? And an effective advisory board or an effective CEO group or EO group, something like that, they push each other to say, hey, Anthony, I know that you really don't want to give this up. Let me show you and share with you what I'm seeing. And I don't think it's there. And I think that role for a partnership is really, it can be challenging, but I think it's really, really important, right? And this is the sort of proverbial, every new investment, it should be viewed as a brand new investment. Forget the sunk cost. Really hard for humans to do. We don't naturally do that. Sort of the proverbial, bad money after good. I also think there's a tendency. There's a book by Annie Potts, which I really enjoyed. I'd highly recommend. It's called Thinking in Bets. And I think there can be a tendency in venture to always look at the decision from a few years ago based on what you know today, right? Few years later, and what the outcome was. And what Annie says in her book is you have to judge decisions by the information you had at the time. And the judge of a good decision was whether you should have made that decision based on what you knew at the time, right? And that doesn't mean she's a poker player. She describes things in terms of poker, but you have a 2-7. right? It doesn't mean, and it eventually runs, turns in your direction. That doesn't mean that you should have played that hand, right? The outcome was the unexpected outcome, not the expected outcome. And so she talks about that relative to startups. And, we've at different times tried different ways of evaluating decisions and decision-making frameworks through the sort of POTS lens, if you will. But I think it's important because a lot of people like to do postmortems. Oh, we shouldn't have put more money in, whatever. You can't judge that based on, well, the company didn't work, so therefore we shouldn't have put money in. Like that may not at all be the case, right? The case might be, hey, based on what we knew, we should have put money back in this company back in the day. And the opposite is true, right? Sometimes you put more money in and it works out, but you should be thoughtful about, did we get lucky and it worked out, or was this a really good decision and it worked out? And that distinction is really, I think, challenging for firms to actually sort of understand.
So we're recording this on December 10th, 2025. You just had your book launch party yesterday at your wife's bookstore. What's the name of the bookstore?
It's a Composition Shop in Longmont, Colorado. It's absolutely gorgeous.
Yeah. So fun times. The book is now out. It's available. What's the preferred method for people to buy it? Is it Amazon? Is it your website?
I would say whatever is easiest for people. So if you go onto our website, which is thecapitalevolution.com, there's an order button and it'll take you to a page where there's a bunch of different options for buying it, whether that's through Amazon, through Composition Shop, of course, through Barnes & Noble, Books A Million, et cetera. But also you should be able to find it at your local bookstore. It's really, it should be pretty widely available. And so what I would say, whatever is easiest for people. And by the way, it's available on Audible as well. The Audible version came out yesterday, the same day the book was available.
All of the entrepreneurs with ADHD that are listening right now are like, oh, thank goodness.
Thank goodness. you and me both. I listen to most of my books rather than read them.
Yeah. So you've been working on this book for a while. Now it's out and you're doing some book promotions and that's going to last for a period of time. And then what? What's next?
Yeah. So this is actually a more nuanced question than maybe listeners recognize. Foundry made the decision. We raised our last fund in 2022. And in 2023, we announced to the world that we weren't going to raise any more funds. We wanted to get ahead of that. We didn't, frankly, just to be super blunt, we didn't want to make it look like we couldn't raise another fund and therefore we decided not to. So we announced it relatively early in that fund cycle. And that was kind of always the plan for Foundry. It was so associated with the 4 original partners. One of my partners has already retired. And, we just got to the point where we felt like it was enough. Brad just turned 60. And sort of the rest of us were like, hey, we've done this for as long as we wanted to do it. So 2025 for me, if I can just sort of share personally, was a year where I thought a lot about, do I want to do something structured? Is there a next thing for me? And the conclusion I came to was yes, right? I'm in my early 50s. I feel like I still have a lot to give back. Things I want to do. I still have a high degree. I have my own version of ADHD, and I like to tell people my mind is a very cluttered place. And I find work is what actually allows me to kind of quiet it down a little bit. So I definitely want to do something next. So that was 2025. 2026 is when I'm going to start really thinking about what that is, and I hope to find what that is. So I'm working on a few different ideas, some of which look more like fullish time work, some of which are a bit more kind of part-time in nature, but I'm really excited about that. I suspect it will involve writing more because I really do enjoy the process of writing. Again, to the crowded mind idea, I find when I'm sitting down writing, my mind quiets quite a bit. And I think that's part of why I love the process of writing a book so much, is that it does sort of allow me to focus in a way that a lot of other things don't. And so it's sort of a long rambling answer to basically say, I don't know, but I hope it'll be something interesting.
Hoping to get some clarity in 2026 as things maybe slow down for you. You get a little headspace to think about that.
Yeah, and give myself the grace of time, right? I felt a little pressure because people immediately after we announced in 23 that we weren't going to do another fund, everyone called me and said, hey, what are you doing next? And I was feeling some pressure around that in 23 and 24 to define what it was. And I was busy enough with the book and other things. I was like, look, I'm just not going to do that. And I really had this epiphany over the summer, in particular this year, so 2025, that I definitely want to do more and something that has some structure to it. So we'll see what happens.
Seth, I've just got one more question for you today, but before I ask it, I want to do three quick things. First of all, tell people the best way to find you, get in touch with you, connect with you if you want that.
Yeah, two ways to get in touch with me. I have a blog. I've been writing for the book, so not as much on the blog, but it's Seth Levine, Levine.com. You can also find me, my email address is all over that. You can also find me at Foundry.vc. That's our corporate website. Again, my email address is all over that. So I would encourage people to reach out. I would ask, don't reach out on LinkedIn. I do sometimes scan my LinkedIn in mail, but it's not a reliable way to reach me. So that's really the best way, is to go find my actual email address and send me a note.
Great. We'll include that in the show notes for folks. Also, as a reminder to people, if you want to get more employees access to benefits that aren't going to hurt them financially and carries a financial upside for the company, reach out to us at addbackbenefits.com. And finally, if you'll take just a quick moment, leave us a comment or a review on your favorite podcast app. They'll hold a special place in my heart forever. Thank you. So last question for you, Seth. A year from now, you and I reconnect and you are celebrating something big. What's that big thing?
Oh, wow.
1 year from today.
Well, I have two seniors in college right now. So I hope it'll involve them being in a really, like, they're launching into the world and into life. I hope it'll be something really positive for them. And I think a lot about my wife's work right now. She's a real estate developer. She's redeveloped a bunch of buildings in our downtown quarter, which again is the town next to Boulder. It's called Longmont, and she's really kind of helped transform the downtown of our city. And so I think also a lot about sort of her and her success. So it may not be the answer you were looking for, but I'm thinking about them. I have a son as well who's sort of at the end of high school here. So I hope everyone's in a really interesting place, and I think that's what I would most like to celebrate.
I love that your 1 year goals are for everybody in your family.
Fantastic.
Very selfless. Seth Levine, I want to be the first to thank you for sharing both your time and your story with us today. I really appreciate it.
Anthony, this is a really wonderful conversation. I appreciate you.
Folks, that's a wrap on another episode of the Inspired Stories podcast. Thanks for learning with us today.